Hello and welcome to this, the fifth in our Bitcoin and Gold in 2022 series from ByteTree Asset Management. Thank you so much for joining us today. We are thrilled to be joined today by James Butterfill, who's the head of research at CoinShares. He is going to be, and Charlie Morris today, are going to be talking about the Bold Index, principally around the construction, behavior and application of what is the one of the first combinations of Bitcoin and gold, these two great stores of value, and how they've behaved and their characteristics. Before they go ahead, just a couple of things to say. Firstly, to be aware that, of course, this is not investment advice. Please consult your wealth manager or expert if you're looking for wealth management advice. This is purely entertainment. Secondly, there will be a recording made available on our YouTube site to join the other recordings, so please have a look on there. And thirdly, please feel free to drop in questions onto the screen, and we will try and get to those later. And with that, I hand over to Charlie.
Thank you, Charlie. And welcome, James. Now, James and I used to work together at HSBC. He was in the private bank upstairs. I was downstairs doing the hard work in the asset management business. But we spoke a lot about gold and had known each other for a long time. So welcome and thank you for coming. There aren't many people that have spent so much time thinking about this subject of Bitcoin and gold as you and I. So you're the perfect one to spar off. James, what I'm going to do is just go through a bunch of slides and add your comments as we go, and we'll talk our way through them. So I'll kick off with the money map, which is the framework for how I think about asset allocation. And essentially, inflation is on the vertical axis and the bond yield is on the horizontal. And we tend to think of inflation as when the value of money is falling. So gold and Bitcoin do well in that environment. And when inflation's low and the value of money is stable, bonds and equities do well. And we tend to associate risk-on conditions with a rising bond yield. The current period's a bit different because we're going through normalization from ultra-low bond yields. But nevertheless, normally speaking, when the economy is expanding, the bond yield will rise. And when the economy is contracting, it will fall. So when times are bad, you want to own gold and bonds. When times are good, you want to own Bitcoin and equities. And when there's inflation, gold and Bitcoin, and when there's disinflation, 60-40 bond equity portfolio. And I just want to talk about this. Do you think, James, that I've got Bitcoin in the right box?
I do. I think what's different between, I've put a lot of thought into this. I've got a slightly different chart. It kind of says the same thing in that gold is not a growth asset, whereas Bitcoin theoretically is a growth asset. You can, I think, look at them and say, well, they're a finite resource. They both are, and so they're both very similar. I think they are in that particular point. But Bitcoin was born out of the internet, and the internet is growing very rapidly each year. I think its most recent measures, sort of last year-on-year internet growth was 56%. And because Bitcoin was born out of the internet, and it's growing very quickly, it kind of makes sense that it is a growth asset. And as a consequence, I think it's right to fit in that box. On the other point, aside from growth, is the inflation element. And I think conceptually, we know that Bitcoin and gold are real assets. Both of them are a finite resource. They're both priced in dollars. There are other real assets to make similar observations about, such as real estate. We just don't have the time history, the time series in Bitcoin to really make this judgment about it being, or to prove that it's a real asset. But we know conceptually, and I think early data does suggest that it is becoming increasingly, the R squared, the relationship between inflation and Bitcoin, is improving, with the exception of the start of this year, which I think is all to do with interest rate, fears of rate hikes, but we can come on to that point if necessary.
Sure. Well, I'm glad, because we're about to illustrate that, but I would like to add one more thing. Also in the grey box could be commodities and to some extent financial shares. So I would think about that too. So we're going to flip and demonstrate why I think Bitcoin deserves to be in that top right box, risk on inflationary asset. And here I've got the price of Bitcoin in black, and in red I've done a bit of cheating. I've taken the US 2-year bond yield and I've added to the 2-year break-even rate. And so when the number's very low, you're in some kind of deflationary risk-off shock, and when the number's very high, you've got money pouring out the ATMs. And in blue I've marked the Bitcoin bull markets, and intuitively you would say that Bitcoin does well when rates and inflation are rising, and it tends not to do so well when rates and inflation are falling. So that's my simple asset test. James, criticize, agree?
Yeah, I think Bitcoin is becoming a hugely interest rate sensitive thing, and it kind of makes sense. Anything that is a real asset will be hugely interest rate sensitive. We've not got the chart here, but if you were to look at the intraday prices on Bloomberg yesterday for gold and Bitcoin, you can see the moment Powell started discussing, they're not entertaining a 75 basis point rate hike, only 50 basis points. At that point, Bitcoin and gold rallied intraday. And I think what that's highlighting, and other incidents, say the 4th of January, for instance, we saw a very similar event with the FOMC where they were much more hawkish than people expected, and both gold and Bitcoin fell. I think that's telling you they are becoming interest rate sensitive. I don't think historically Bitcoin has always been that, but as it's maturing as an asset and investors start to understand it better, it is definitely becoming one, and that makes sense.
Good. We shall move on. Now, I think that one of the problems with the everything bubble that we're living in today is, we know that the asset prices have been very high in 2021, and there's a bit of an adjustment going on now. To our mind, and I don't want to labor on this too much because we're not doing a Bitcoin talk, we're doing a Bitcoin and gold talk. But, and I will skip this quickly, but we can come back to this thing, and we write about it in ByteTree. But basically, we believe that Bitcoin, its valuation is closely linked to its usage, its network, and the red line reflects basically the level of blockchain activity. And so it's a demand story, fixed supply, it's a variable demand story. And the difference between 2014, which you can't see, and 2017 and today is that actually the price is in line with fair value. Simple as that. So I don't think there's a Bitcoin bubble. I think it's well underpinned this year, which is pretty exciting. James, disagree?
No, I do think, I'm not a big fan of technicals, but if you are, then we are close to a technical floor. On that front, we at CoinShares did a massive 3-part webinar series on valuations where we looked through a whole range of different valuation approaches, such as Plan B's stock to flow, for instance, which I think is rubbish. There's a whole load of different valuation techniques. One way to consider it is looking at what proportion of gold market share that Bitcoin takes. I think the two complement each other, but you could say that it could transplant some of gold's market share, and now it's 25% market share. That equates to around $70,000 per Bitcoin. But there's lots of different ways that you can do it, and I don't think the industry has the investment world has particularly, I think, settled on one particular metric yet.
Sure. I think my simple point is this is very different from the bubble peaks in 13 and 17, and the level of activity is well underpinned. And that's what I think is pretty interesting about this cycle. I think the risks to Bitcoin are much lower than people think. My gold valuation model, very simply, this is the price of gold compared to a hypothetical 20-year treasury inflation protected security. So that's a TIPS, 20-year TIPS with no yield. If you calibrate that, and we've done that, and it's available on our website, once again, we've got gold that's trading at fair value. So we've got Bitcoin at fair value, gold at fair value. And what we're going to demonstrate is when you put these two assets together, you get a magical outcome, a very high quality outcome. And there's, this is an escape from the everything bubble. You're not paying a premium for either gold or Bitcoin, which is a nice place to be.
Yeah, I think I look gold and Bitcoin for that matter is very much kind of hedges against policy errors by central banks. And I do think we're headlong into a potential central bank policy error in the United States. And in the UK, I thought it was amazing today how they discussed rate hikes, but at the same time, we're discussing the threat of the high chance of a recession this year as well. So that, to me, smacks of a central bank that has not hiked rates earlier. And I can understand, actually, because of COVID, but we're in the situation we're in now. And it's the high chance of a policy error. So something like gold, from a valuation perspective, definitely fairly valued, if not undervalued, given the risk of a policy error.
Good, we're in agreement. So in constructing the bold index, how do we do it? Well, we take the volatility of gold and we take the volatility of Bitcoin. Gold's basically a 15% type volatility of around 15%, roughly speaking, and which basically means that on a typical day, the move should be less than 1%. And the Bitcoin volatility here using 360-day reading is 60%. So it's a lot more volatile than gold. And what we're going to do is put more money into the less volatile asset. So there's lots of gold in this bold combination and a little bit of Bitcoin. Which is Ray Dalio's quote, isn't it? I'll take the gold and sprinkle a little Bitcoin on top.
What this chart omits, though, is gold's volatility in the early 1980s. And it had 90% annualized volatility in the early 1980s. And I think that represented, although gold's been around millennia, obviously, it wasn't really being used as a modern portfolio diversifier or asset until this mid-70s when the ban was lifted in the United States. And I don't think people quite knew how to treat it or fully understood it. And as a consequence, its volatility is very high. I think Bitcoin is in that situation right now. It's people don't understand it, but as people's understanding improves, the volatility is likely to decline. Don't forget, Twitter, when it IPO'd, had a volatility of 130% on an annualized basis. People didn't understand how it was going to make money. I think the encouraging thing we can see here is broadly over this time period, you can see the trending down. And if you follow that trend further, it does suggest by about 2025, 2026, we will see much more moderate volatility in line with things like emerging market assets or EM currencies, for instance.
Yeah, I totally agree with that. And so, you know, the point of this construction of the portfolio is that over time, Bitcoin will get the weight it deserves. So if it wants to behave like Amazon in 2001 or Twitter after IPO, they won't get a very big share in the portfolio. But if it wants to grow up and become a proper monetary asset that's widely owned by institutions, then the weight goes up. So that's the point there. And here's a little bit of maths, which I'll talk you through. It's dead simple. In this example, imagine Bitcoin with 60% volatility, gold was 15. We do 1 over, so 1 over 60% or 1 over 0.6 is 1.67, 1 over 15% is 6.67. We add them up. And then we do the blue to blue. So you can see the blue number repeated in the next one. And then the weighting in this case is 20% Bitcoin and 80% gold. So that's just an example. And that exercise is carried out once a month. And the portfolio is rebalanced. The bold index is rebalanced to those weights. And obviously the input is the volatility reading at that point. And we'll move on because I don't think there's much to come back on there. It's basic financial maths. And going back over time, that's the outcome. So from 2016 to the present day, gold in gold has had a high share. That share went down in 2017, which was a very, very volatile time for Bitcoin. And then it started to go up in 2019, 2020, and has leveled off at around about 18.5% most of the time in recent months. So inverse volatility, James.
Yeah, I mean, at CoinShares, we've created a very similar index to this and drawn very similar conclusions. It's a bit of a love-in, isn't it? But I think our approach has been slightly different, where we have a volatility targeting of 80-20 between a basket of crypto assets and gold. But ultimately, it is with that sort of similar sort of goal of trying to get exposure to crypto assets whilst having the safety of gold to some extent. I suppose the vulnerability of this portfolio is that they are interest rate sensitive. So if you were to believe that interest rates were going to be continue to hike very aggressively. I personally doubt that. I think the natural rate for interest rates in the US and in the UK are very, very limited. And we could well find ourselves in a stagflationary environment. If not, we're already in it. And that is when this kind of strategy would do particularly well. But I think it's worth being mindful of that point, that it's
which comes back to the first slide, when no one's claiming this is going to work in a deflationary environment, that's where you want to go and buy your bonds. We're saying that in an inflationary environment, these assets are complementary and they have the risk on benefit. And so you tend to look at the screen and see, gold up on a day, Bitcoin's probably down, and when Bitcoin's up, gold's probably down. And that's why you actually get such a lovely outcome. And that's the point of diversification. But good points. And how's it done? So the Bold Index, starting at the beginning of 2017, obviously 17 was a very nice year for Bitcoin, so a bit cheeky, but we will show you another chart in a second. But nonetheless, it happened. I think the 2018 bear market for the Bold Index was pretty impressive. Basically, a drawdown of around 14% or less, and despite the fact that Bitcoin went down 84%, so really not that bad. And and then gold gets going at the end of 2018. Bitcoin's not doing much at this point. But the rebalancing, every single month you're buying the one that did worse, selling the one that did best, going back to your target weight, which is based on risk. And the outcome's pretty spectacular because you're adding a little bit of value every single month. And, a couple of shocks that we've had a shock in 2020 in March, and a very, very narrow, shallow drawdown because of the gold weight, despite Bitcoin going down quite a lot. And then 2021, not the best year for the Bold Index, but nevertheless, it didn't move far apart from the other mainstream indices. Quite a lot of correlation with assets, it seems, over time, but on a risk-adjusted basis, for the amount of risk you're taking, the outcome's pretty sound.
Well, I actually think real assets have faced quite a few challenges this year in particular, but it's not, and many have critiqued real assets saying, they're not really inflation protection. We've got inflation running really high, and yet real assets aren't performing. I just think not yet they're not performing. It's particularly unexpected inflation that they don't. I think the threat of exceptionally hawkish Fed has really pushed down real assets for now. But the Fed has, and many central banks have, a history of knee-jerk reactions. They wait till it's too late to hike interest rates and then hike too aggressively. And it's just that playbook is playing out exactly as we would have expected. So I wouldn't see the poor performance this year of the Bold Index or the CoinShares Gold and Crypto Index to be an indicator of it not working. I'd say it's just biding its time until policy mistakes really sort of kick in.
Yeah, and let's face it, asset prices are down massively. I mean, the Nasdaq's not exactly having its best time. But let's look at the risk now, or volatility in very simple terms. And this is usually 360-day volatility, which is the method we use for the construction of the Bold Index. The reason we use that, and I touched on that, is really you want something long term, a whole year rather than 30 days or 90 days, because you're picking up a lot of tactical signals in that, and they're not necessarily directional tactical signals. So you want to screen that out. We're just trying to say, how is this asset behave in general terms? And the great thing about this outcome is we've got a Bold Index that's now got lower volatility, the Nasdaq, which I think is pretty encouraging, and the volatility is falling at a time when the volatility of equities in general is rising. So that's pretty reassuring. Of course, gold itself is quite low. But I'd also highlight that, actually I'll do that on the next chart, but we'll flip past, I'll bring you back in, James, in a couple of slides time, so we get to a time target. That's the performance over the last, since the beginning of 2020. And I think what's interesting here is that, the shallow nature of the drawdown, how gold is very gold-like in the early 2020s, and then it picks up and carries on with a little bit of Bitcoin that goes a long way, I think you wrote in one of your research notes.
Yes. Yeah, we talked about it a lot in portfolios. We've got a few charts coming out, haven't we, to demonstrate that best.
We do. We're going to push on because the interesting bit's coming. And that same time frame since the beginning of 2020, the volatility of this is consistently lower than equities in both the drawdown in March 2020. Bold was much less volatile than equities as a shorter term measure of 90-day volatility. And you can see why I wouldn't want to base the index on this because it's all over the place. But nevertheless, I'm using this chart to demonstrate how during times of crisis, the volatility of bold has consistently been below the levels of the stock market. And that is why I believe the Bitcoin gold combination is a high quality asset.
Yeah, I mean, I don't forget bold has Bitcoin in it, and yet it's well below the volatility of, say, the Nasdaq 100 here, which is really interesting. The combination do complement each other very well for that matter.
Now, James, I'm going to hand over the next slide to you because it's your slide. Now, this is basically he's mentioned the CGCI, which is very, very similar to bold. Let's face it. Yeah. And go and tell us about why, what allocation to a portfolio makes sense for you.
Yeah, so I initially, there's a lot of numbers here. So the top section, various asset class performance, is just to show outright how things perform. And so CGCI, as Charlie said, very similar to bold. Its annualized returns since 2017 have been 64%, so particularly high. This has benefited slightly more than bold in it has the top 5 crypto assets. It's not to detriment it because there are times when in the top 5 it's really underperformed too. If you take this from 2018, in fact, Bitcoin on its own tends to do exceptionally well. I've got Bitcoin in this chart here, and you can see that Bitcoin does particularly well. Its annualized returns over this period have been 97%. The issue you've got with just Bitcoin on its own, though, is its maximum drawdowns are exceptional, 83% peak to trough over this period. Whereas combining gold, its max drawdown over this period has been 18%. If you combine gold and Bitcoin, you get a max drawdown of 26%. Now, that might seem like a lot, but then when you look in context of the MSCI world, actually equities have had a higher drawdown over this period than the sort of bold or CGCI index. And I think that's quite compelling. Yes, it does add more volatility, but there are ways of dealing with the volatility issues. So you can regularly rebalance, for instance, and that helps volatility. And that's what I've tried to do in this balanced portfolio. I've just taken in the image below various asset classes performance in a balanced portfolio. I've just taken 60-40 portfolio and said, let's add 4% of CGCI and see what happens. And what you find is the annualized returns improve over and above the 60-40s from 8.8 to 11.5%. The maximum drawdowns barely budge. So it doesn't really have any effect on drawdowns. And it has no effect on the volatility in the portfolio. It did take me a while to get my head around this, but because it has quite a diversifying component to it, it really helps. It doesn't cause any sort of additional pickup in volatility. So in a way, I hate to say it's a free lunch, but it is almost for no additional volatility, you're getting greater upside. And you're getting a Sharpe ratio over this period of 1.06 and an IR of 2, so fairly healthy. You could decide to just go for Bitcoin straight out in the portfolio. The only downside of that is you do take a hit. There's a greater drawdown and greater volatility. It's for a while though. It took me a while to figure out why actually max drawdowns weren't much bigger for Bitcoin on its own, and it's partly quarter rebalancing. If you are worried about anything with Bitcoin in it, a regular rebalancing really helps put a lid on the volatility issue you might find. I mean, not that there's a big volatility problem at all, in fact, with CGCI, but it is greater than equities, but the drawdowns aren't as bad. And I think that is partly its diversification merits. I've also included the Bloomberg Galaxy Index, which is the sort of top 10 crypto, which is actually quite hard to invest in, but I mean, I think what it's telling you is actually if you go for something that is more diversified, the theory is you buy something with greater crypto assets, the more diversified it becomes. But the reality is actually the top 10 crypto, adding that, is a more volatile asset than, say, CGCI or Bold or Bitcoin on its own. Even you add the drawdowns of the top 10 cryptos are greater than just Bitcoin itself.
Yep.
So
I'm glad you brought that up, James, because I think in crypto, the further away you go from Bitcoin, the diversification benefits don't exist. It's like adding silver to gold. You end up with a riskier portfolio than just gold on its own. The conclusion that it was.
I'd say not yet. I think there will be a huge amount of attrition in the crypto space. There's lots of projects that pretty much do the same thing, and eventually users will settle on one or two. Also, I think there's a lack of understanding at a lot of the crypto projects, and therefore people tend to sort of treat themselves. Their fundamentals aren't necessarily driving the prices they should do, like in equities. And I think that's part of the reason. So perhaps as the industry matures, that will change, but certainly historically that's not been the case.
Great. Well, let's have the fun bit now, and let's look at how Bold performs against different widely owned ETFs. In Europe. And so this is the S&P 500, which, when would you have liked to have owned the S&P? I suppose that the last couple of years, you could argue that it's been about the same as Bold, but, it has been a downward journey most of the time. Yeah. I'm just going to fly through these, James, in the interest of time, because I know you've got a deadline. And this is US value. Value investing is very much in vogue at the moment because we're in an inflationary environment and it outperforms. But even still, it's not totally clear that is a place that's doing materially better, particularly during the risk-off periods. It's been much, much worse. I mean, you have to look at March 2020 to see that. I'll bring you in a sec, James. We're just going to fly through robots. Very popular allocation. People have been sapping this one up, and I love robots. I got a robot that mows my lawn, but it's not as good as Bold when it comes to fine investment indices. The gold miners. I'll bring you in on the gold miners because I think the sort of people that like crypto probably like gold miners too. Quite interesting relationship, this one.
Can I just make a point here, Charlie? There's this theory that gold miners and gold miners can be a proxy for gold, and that's never really been the case historically. The gold miners are not a good proxy for gold, but it's a bit like blockchain equities. They are not a good proxy for Bitcoin, for instance, or crypto assets. It's the same sort of parallel that exists.
A point very well made. And at this point, I was going to put a well-known European blockchain equity fund in, run by your firm, but I thought that'd be a bit rude, so I didn't. And now we've got gold against Bold. And obviously we know the performance of gold has outperformed. And sorry, have I got the same chart there? I beg your pardon. I got the wrong chart. That's my fault. So that should be gold itself, but I put gold producers in for the second time. We've got silver. We'll move straight on to silver. I mean, come on, let's have a bit of fun with this one.
Oh, what's
it's the most disappointing allocation this cycle. I mean, I'm a big fan of silver. I think it's cheap, but it never seems to want to play.
Yeah, I mean, I don't know what to say about this. I don't know. I mean, for me, I think silver is much more of an industrial asset, and as a consequence, I wouldn't expect it to sort of, I suppose, benefit in the way that gold does in the Bold index.
And then just because I think it's unfair to put things that are underperforming Bold, you can outperform Bold. And Saudi Arabian equities are in an uptrend against Bold at the moment. So that's just in the interest of impartiality. And also the MLPs, energy infrastructure, that's starting to show a bit of a breakout. So there are some things to do. But the point about these are highly cyclical assets, and they might be good in the short term. I think the point I'm trying to get across is that Bold's a great long-term buy and hold investment. And I think I want to finish on this slide before we've got a couple of minutes for Q&A. Bang on time. Charlie Harris probably looking his watch. That the outcome of a gold Bitcoin risk-weighted index has an extraordinarily close overlap with inflation expectations. And the point you were making earlier, James, about inflation expectations, you're saying that you get the spike in bond yields, the risk of the Federal Reserve and so forth, overdoing it. I think that the big shock this in markets is that the bond market doesn't think the inflation's as strong as the data and the price of oil indicates it is.
But I suppose it's the bond market is near inverted too. So I mean, I struggle to reconcile that one personally. I know that oil in particular, I think what the bond market's trying to price in that is we must be near the peak in oil prices, and just inflation generally. But I think what we've seen over the last year or two actually is that it consistently beat expectations, and the inflation surprise index seems to consistently, the Citigroup one consistently beat expectations. That's what worries about me like this. And once the inflation genie's out of the bottle, it's very hard to put back in. I think it remains inconclusive yet whether the central bank rate hikes will put a lid on inflation.
So I've stopped sharing, Charlie, and we've got a couple of minutes for questions.
Yeah, guys, that's just a fantastic roundup, and there'll be a lot for everyone to go back there and have a look and see what a great risk and return diversifier Bold is, especially in the sort of context we have today. We were asked about the largest drawdowns that Bold has experienced, Charlie, and how that compares to other assets. From what I've got in front of me, the answer to that is in 2018, the Bold had a drawdown of 16% at a time when Bitcoin had a drawdown of about 76%. So hugely took the sting out of that move. And the pattern of behavior has been similar since.
Can I come in there? Of course, that was from 2017 when the volatility in the Bitcoin was really high, and so therefore the weight in the index was quite low. Bitcoin's most likely to collapse from a period of volatility than it is from a period of calm.
Yeah. And that's about it. But I would say to everyone out there who's listening to this, do get in touch with us at ByteTree. You can find everything on our website at ByteTree.com. And to wrap up, to say thank you so much, James, for sharing your expertise in this area. It's been great to have you. Charlie, last word.
Very quick point. Yeah, just I really want people to go and have a look at Bold and give it honest criticism or independent research analysis. We'd love to hear more about what you have to say. Ask us. We will send you data if you need it. You could download the Bold Index on the ByteTree Asset Management website. That's ByteTreeAM.com. Or you go to ByteTree.com and click on Bold. You'll get that. It's the bottom right corner of the chart. You can download it and have a play with it. And we've got some other tools there as well. We'll be rolling out more. So we would love to hear your feedback on this exercise. And again, I'd like to reiterate, thank you so much, James. It's hard to find a true gold Bitcoin guru these days, and I think we're going to be in hot demand over the coming years.
I hope so. Thanks, guys.
Bye all.
See you.